real life.
So I was sent this client to review their policies from a wealth management group locally that sends me their clients. And upon review, this guy had a whole life contract, put it in place in the late 80s. The client never reviewed his contract. He built it in a way that he was paying a premium based off the assumption of what that crediting rate was. When I got to it, and this was maybe 7-8 years ago now, but when I reviewed it, I saw that the way that it was structured was there was an automatic premium loan withdrawal that was part of the contract that he was never aware of. So the underfunded amount of the premium that he wasn't paying was borrowing against the cash value internally, and he wasn't aware of it. And when I reviewed it, the contract had, the account value was like somewhere in the million range, but the loan against it was somewhere in the 750,000 range. And the basis of the policy was like 300. So, there's a $400,000 gain within this contract that's already been borrowed against. And now he's in a position that he didn't realize he was in. And if he doesn't change anything or start to offset these costs, in 10 years, the policy would lapse and he would have otherwise received a 1099 out of nowhere for 6 figures. And he would have had to pay taxes on that and he would never have known. And all of that is due to what were the assumptions when we first put this in place and him never managing the contract along the way. To me, the biggest takeaway is these things change over time. And it's up to the policy owner and hopefully the agent or the financial advisor selling it to manage them properly. And if they would have managed it as rates came down, the pain would have been far less if they just would have checked in on it on a regular basis than where it left him when I saw it, 25 years after the fact.